The following presentation is a 40-minute segment from a larger 5-hour training course presented in December 2020 that was titled 2020 AML Training for Virtual Currency Businesses and Other Compliance Professionals. Your moderator is Carol Van Cleef. If you're interested in viewing the full 5-hour course that was presented by Luminous Group in the AML Training Institute, please contact Luminous Group today. To receive credit for this presentation toward your annual AML training requirement, a certificate of attendance may be provided to you for a nominal fee. For this segment, I would like to introduce your speaker, Justin Ehrenhofer, who is a founder at ComplyFirst and a compliance analyst at DV Trading. Justin will be discussing privacy-preserving cryptocurrencies with respect to AML compliance. Thank you for joining us, Justin. It's a pleasure to have you here, and we're looking forward to how you can give us some insights into some very important issues around the customer due diligence subject.
Thank you so much for that introduction. Yes, today I'm here to talk about privacy-preserving cryptocurrencies, sometimes known as privacy coins or anonymity-enhancing cryptocurrencies. It really goes by 700 different names. However, I'm here to talk about how you, when you're implementing a compliance program, can properly ask for the required information that's needed in order to support privacy-preserving cryptocurrencies, things to be aware of. And then also, I'm here to talk about some important things that you should be looking for, things you should be remembering as you are implementing programs for things that people typically don't think of as privacy-preserving cryptocurrencies like Bitcoin and Ethereum. The implications on how you specifically do your KYC on customers, the implications about what sources of funds you are receiving. In many cases for Bitcoin and Ethereum, this is public information that the regulators will be able to just look up and see what previous history of funds that you have received or sent. And this is even things that other exchanges can see too. So I'm here to talk about that today, to give you a good starting point. Quickly introducing ComplyFirst for like 1 second here. So ComplyFirst is an open industry initiative to support privacy-preserving cryptocurrencies and tools. Keyword 2 there on the tools. It's not just about things that you may consider a privacy coin. It's also on the ways that people use privacy-preserving tools on Bitcoin. These are increasingly common. We put out resources that are meant to be specifically actionable. We don't just talk about how, you may want to collect some more information. We specifically try to show how you can specifically do that and what everyone else in the industry is doing. So if you are interested on making very actionable resources, this is our contact information if you are interested in getting more involved. But why is ComplyFirst so interested on privacy-preserving cryptocurrencies? Well, first, privacy-preserving tools and the coins themselves that are privacy-focused are not going away. You can see some of the numbers here, for example, comparing the monthly transaction data for November 2020 and November 2019. And you can see, for example, Monero transactions have more than tripled, Zcash fully shielded transactions have more than doubled, and Samurai mixing rounds and mixed volume in Bitcoin has increased more than 10 times. Samurai, for those who are not aware, is a more decentralized coin join mixing tool for Bitcoin. So certainly the adoption of privacy on these cryptocurrency projects is not slowing, and we do not really expect it to at ComplyFirst in our view, because these are open permissionless networks. People have more and more time now to put together tools that work on any specific cryptocurrency. And so there are people that will try to attempt new ways, better ways that better protect the user's privacy on really any of these networks. So even
Justin,
if you think, go ahead.
I'm sorry, if I could just ask a real quick question and looking at these numbers, which is quite impressive. Two things have happened in between 2020, November 2020 and in that year time period. One is we've had a number of exchanges turn off transactions in Monero and Zcash. And I guess, how does that play in these numbers? It seems like there may be some distortions potentially. And the second is obviously with the increase in price of Bitcoin and so on, you've got generally a higher volume of transactional activity. I guess, how do we sort through that noise?
Sure thing. So in these cases, these are independent of the price of any of the particular assets. So when I say the Samurai mixed volume is up 10 times, I do not mean the US denominated volume is up 10 times. The amount of Bitcoin that is specifically mixed is actually up 10 times. So the US denominated value is actually, it would have to include appreciation, which would make it even more significant. And I think we're seeing here that, you are right that some smaller virtual asset service providers, exchanges in particular, have de-risked by deciding to stop listing, privacy preserving cryptocurrencies. This is mostly the case in jurisdictions outside of the US. However, we have seen some US exchanges do this as well. And I think, that is perhaps the simplest method that a cryptocurrency exchange may do to signal that they are in compliance, that they are not interested in higher risk assets. But our view at ComplyFirst is that you already need to deal with these cases for people who mix on Bitcoin, and these numbers are not slowing down. In fact, they really are accelerating. So, it's one thing to signal you don't want to, take on unnecessary risk, but these are risks you already are accepting and need to properly mitigate, really regardless of what network you're supporting and whatever, assets you support. So it's interesting. You are right that Monero is perhaps listed on fewer exchanges, but it's still listed on Kraken, which is U.S. regulated. However, despite the few exchanges that have delisted Monero, there are perhaps fewer venues than there were even a year ago. The transaction volume is still increasing significantly, and I think really the thing to point out here is that the demand for privacy really doesn't seem to be going away. And if it's not listed on certain compliant exchanges in some jurisdictions, the demand seems to go elsewhere at the moment, where Monero is more frequently traded on less compliant in less compliant jurisdictions and on less compliant exchanges. So it's, in our view, inadequate to simply say that privacy is someone else's problem that we as a VASP don't want to deal with. We want other exchanges who are more risk tolerant, perhaps, to address these. Just if you look at any reasonable privacy adoption metric on any of these assets, the vast majority of them show that users are increasingly aware of how to use these assets in a way that tries to give themselves more privacy. We see this with, for example, on Bitcoin, where Samurai and Wasabi wallet use is in general way up compared to last year. So these are certainly things that virtual asset service providers and exchanges, in our opinion, should be addressing right now, and certainly need to have a more formalized response going into the future, in our opinion. So unless there are more questions on the specific adoption of privacy, which is generally increasing despite regulatory focus more in this area, we still continue to see users take on these technologies more, regardless of whatever base asset they use. And I want to also stress, like, the entire idea of what a privacy preserving cryptocurrency is quite broad, and it's, in our opinion, it's insufficient to simply try and classify an asset as either a privacy preserving cryptocurrency or not, because there's far more nuance. If you look at, for example, this chart here, I usually like to divide things in a few ways. So first, I like to divide it into these two rows here. Is the privacy feature on the network something that is widespread? Is it implemented such that every transaction, or in some cases perhaps quite a few transactions, do include this specific type of privacy preserving feature? Or is it something that's opt-in, that only, let's say, 5, 10%, maybe even 1% or fewer transactions are adopting? That is indicative of the types of users, the sort of network activity that is likely to use these privacy preserving features. And then further, I like to divide it into specific columns. So on the left there, you have coins that are more focused on specifically the idea of privacy. Part of their reason for existence, creation, the reason why a lot of their development teams focus on the project is specifically to improve privacy on the base layer itself. And further to the right, you have projects that are, implementing it like as perhaps an application level feature, whether it's wallets that are specifically providing some additional anonymity, and it's perhaps less an interest and focus of the coin. So if you look, if you were to just say what's more likely to be a privacy preserving cryptocurrency and what isn't, certainly things that are in the upper left of that table are certainly more likely to be described as privacy preserving cryptocurrencies. But even those in the lower right-hand corner that are perhaps less commonly referred to as a privacy preserving cryptocurrency, you need to remember that these are still open permissionless networks and many things still apply. So for example, people do use privacy preserving features on Bitcoin. And so you will need to have policies that that approach those. It's insufficient for you to, example, say someone can optionally mix on Dash, and so therefore we consider it a privacy coin, based off your own analysis, while ignoring that people have access to far greater sophisticated mixing tools on Bitcoin, Litecoin, Ethereum even. And so it's, in our opinion, too many people focus specifically on what is a privacy preserving cryptocurrency to try and de-risk. They really need to be focused on what their users are using these coins for, and in this use, what specific privacy enhancing features and tools they are using in this process. So on ComplyFirst, we have resources for all of the coins highlighted green here, the 5. We do not have one for Litecoin. At the moment, though, you can treat it just like you can treat Bitcoin. They're effectively the same. However, Litecoin is considering adding confidential transactions, which will move it a little bit closer to how you would address cases like Grin. So we have some initial basic resources there to help you get started, and knowing some of the specific unique attributes to these coins. I will not be going through all these coins specifically. We do have resources, including that one, our first webinar, which is public, listed on our website, where we do go through some of the basics on each. And I'm sure, if you have any questions on any of these in particular, I'm able to answer questions on these also. So yeah, Ethereum is the next one on our list. We received a lot of feedback of the risk on Ethereum, with more and more users, using decentralized exchanges to trade Ethereum, and then also the potential adoption of additional network-wide protections and also wallet-wide privacy protections on Ethereum. Also, those are still being built. So even coins that you support now, right? People are using privacy features on them right now, and they have for years. They've just substantially been adopted in the future. In the last year. So switching gears here a little bit, I want to remind people that as you are implementing an AML policy and procedure, a set of policies and procedures, your wallet addresses are generally considered public information. And so the implications of how good or how perhaps inadequate your specific AML policies and procedures are is actually viewable to regulators, even other exchanges, and sometimes this information is visible enough for just everyone in the public to know, to be able to connect your wallet actions, your onboarding actions with your AML policy, like how effective your policies are. So for example, like let's say the exchange, which I'm conveniently calling the U exchange or your exchange there on the left, you receive deposits and withdrawals. And it's very common knowledge for Bitcoin and Ethereum and really most cryptocurrencies for the information on all of the deposits and withdrawals to or from you and all the addresses that are associated with it to be public knowledge. So let's say one of your users, which I'm calling a customer for C there, they receive funds that are sanctioned and then they deposit it on your exchange. I want to just stress the real gravity of the situation here, where it's not just that you have received funds that have ties to sanctions. That would be bad enough, but further, the fact that you received these funds at all is knowledge to regulators, and it's also knowledge to other exchanges, and this is based on the public record. Like there's a public undeniable record that you received these funds. And so, especially in the case of sanctions where OFAC has public lists, anyone could notice that you received these funds, or that a user perhaps withdrew funds and then went to a sanctioned entity. That also is public knowledge. So as you are implementing, these policies and procedures for, knowing what information to collect on customers, like absolutely bear in mind that when you are transacting on a public ledger with these customers or counterparties, that the actions you take are given to the public. It's not just information you will disclose when asked. If someone could just look at the cryptocurrency landscape, notice that sort by what exchanges have the highest increase of risky related funds that they've received, and then use that as a starting point. The regulators already have a starting point when they are deciding who to look at, because all this information is public knowledge. So it really raises the stakes. Just to show you an example of what that could look like, let's say someone is interested in learning more about your exchange. They use a leading blockchain analytics software to review your exchange, and they determine that, like, for example, the overall assessment of your exchange is, okay, this is kind of medium risk, right? They can see the specific amount of funds that were received tied to risky behaviors, for example, darknet markets. They can see how much you've received from things like mixing and instant exchangers. They can also see things like, oh, well, you sent this much money to users who then sent funds to sanctioned addresses, and this exposure related to sanctions is up, let's say 132% since last year. This is public knowledge. So when you are implementing your policies and procedures, I really, really stress to you that this is information that people can see several hops from what you're doing. You need to be very, very cautious and take very, very seriously the obligation to observe the source of funds that you're receiving. And then further, you should watch what your customers are doing with funds that they withdraw from your platform too.
So Justin, if I could interrupt here, if I'm hearing you correctly, not only are the regulators doing their own sort of review and assessment before they ever, and the regulator, IRS, because that's the examiner here, they're doing that before they come in to do an examination. But you're saying that the users of the customers are doing that same kind of thing and deciding which ones, depending upon what they want to do, where they sit on the spectrum, they're deciding that you're an easier mark than the next guy.
I don't think that. So I would define this as two different types of users. There's the what I'm going to call the retail user. The retail user is definitely not using these tools. They do not necessarily know how to connect exchanges with the specific exposure they have. They are not the ones that would see an outline like you see here. What they're most likely going to do is look around. If they are trying to make a riskier transaction, they are going to look around and see what KYC information is requested at onboarding, and to see if there's any reports of this exchange doing enhanced due diligence. Typically, enhanced due diligence is just by nature of the process, it causes a bit of friction, and sometimes it causes user grievance with your platform. They don't really understand, even if from their perspective, you have users that do deposit illicit funds on purpose, and then they're caught, and that's the whole point, right? You want to catch those people. But then just based off the open nature of the blockchain protocol, you may have a user that does not understand that mixing is a higher risk situation for exchanges. So they may read online that they're supposed to mix their funds, do so, deposit on an exchange, and then the exchange will ask them for more information. And then the person will get mad and complain about it on places like Reddit, Twitter, the like. So if someone is looking to make a risky deposit, they won't have access to these blockchain analysis tools like Chainalysis, Elliptic, CipherTrace. There's a dozen of them. But they will look around and do some research to see where they're least likely to get questioned for these types of things, and they're going to target exchanges that require them to provide the least amount of information and have the fewest complaints of additional, enhanced due diligence. However, on the institutional side of things, certainly every exchange that pays for this type of tool is looking at other exchanges and seeing what their risk profile looks like. So, I work for a cryptocurrency OTC desk called DB Chain, and when we are determining, in our risk assessment where we want to, trade coins with, we will look up these, these exchanges and see what risk exposure they have to make sure that, that's one signal that we use in addition to others in order to determine, how risky the exchange is, or how seriously they take the due diligence requirements that they have. So yeah, this is information that is accessible to whoever pays for a blockchain analysis tool, and certainly regulators would fall under that definition. So let's talk about who the users are now of privacy-preserving cryptocurrencies and tools, right? Because I think it's an important distinction here that, who are these people? So it really depends on, at least at a large scale, whether the privacy-preserving feature is an opt-in feature or it's a widespread feature on the network, because it really does speak to a large extent user intent. And if something is opt-in, that's certainly a better risk indicator than if something was just used as a nature of the platform. So if you have an opt-in feature, for example, this includes things like Bitcoin mixers, or you could even include things like instant exchanges that do not require KYC or other higher risk exchanges. These are typically used by people like privacy fanatics, people who do put privacy above all else. They're going to opt in to use a privacy feature. You also have illicit and criminal actors that do want to hide their activities, so they're going to opt into as many privacy features as are available for the network. You have researchers that are opting in just because there are some of the few people that do know how to use these tools properly. So you will often see use among these sorts of experts. But beyond that, you don't really see that many people using privacy-preserving features on Bitcoin if there's a user experience degradation. For example, imagine someone is arbitrage trading across exchanges. They're going to lose their arbitrage opportunity if they want to opt in and do several days and spend money for mixing, right? It's just not part of the conceivable behavior of someone who is doing opt-in. So if you had a user that says oh, we're an institution and we're onboarding with your platform and we make markets, but then you're noticing that they're constantly sending you funds that are mixed, that really does not align with their intended purpose of using your platform, right? They're spending extra cost to put these funds through, so they're going to lose their arbitrage, and then they're also spending all this time, so of course they're losing their arbitrage. However, if instead it's a widespread feature, it does capture a broader array of activities on the network, and I just want you to be aware of this. So in addition to the 3 sets that you have before, you also have just general crypto nerds that are transacting in crypto because they like crypto for whatever reason, right? You have speculators, and we don't need to kid ourselves, right? For any cryptocurrency network, including Bitcoin or any privacy-preserving cryptocurrency, speculators do make up the majority of the network in every single one of these cases. So you include all of those. If speculators all start using privacy-preserving features, then the set of users who are using it is quite broader, and you're going to have far more false positives. You may also have people who are mining or staking, everyday users. And then, of course, people who don't want to accidentally get tainted coins. Most people think of this last set as just criminals who have tainted coins and are trying to make them not tainted anymore. But as I described earlier, exchanges don't want to receive tainted coins either. It's public knowledge that you are receiving, or I would perhaps not super public knowledge, but it's generally quite public. Certainly, it's public to other purchasers of blockchain analysis tools, including regulators, that your exchange may receive tainted coins from time to time. So you need to have procedures in place to mitigate this. Certainly you do not want to receive tainted coins. And if you're a user who isn't paying for these tools, really the best way to reduce the chance that you are receiving tainted coins is to use more fungible assets, since you don't have a good mechanism of doing this testing beforehand, because most end users aren't paying for this. Just to set a quick example here, for Monero, for example, all cryptocurrency transactions do hide the sender and receiver and amount, and it also has a CPU accessible mining algorithm. So if someone's using Monero, it doesn't mean that they even intended to use a privacy feature. However, they do get the privacy benefits, and so you need to address those risks appropriately. But perhaps it's inappropriate to assume that it is, a user that has tried to use a privacy feature or has the intent of, laundering money. That's not necessarily correct. It could just be the only currency that they are able to mine, or it could be just where market making opportunities happen to be present. So they are trying to, make money through typical trading activities. And then let's not forget that some people do have legitimate reasons for privacy too. So even though we can treat it as a risk indicator, we need to be very careful about how we do so. And we need to make sure that our response is quite focused on, what people are specifically doing. So moving on to sort of what risks and mitigations you have, this is where we get into the nuts and bolts on how you specifically implement compliance programs, not just for privacy preserving cryptocurrencies, but also use of privacy preserving tools on cryptocurrencies. So let's talk about how you probably evaluate risk here. And I am assuming most of you, if not all of you, use some form of chain analysis tool. It's certainly recommended that you do use something, because if a regulator asks, why aren't you doing this? You should have done this. Like, this information is publicly available for, blockchain analytics companies to put together. So you should pay someone to have insight to this data. You may evaluate risks differently depending on where they come from, and you definitely should. So how do you currently treat situations where you receive funds from, let's say, a regulated exchange, or it might be lower risk, and then going down the list, potentially higher risk, things like, cryptocurrency ATMs. Certainly things like high risk exchanges, darknet markets, and sanctions are things you do want to avoid. So at ComplyFirst, we asked around to see what people are doing right now, and it generally looks like this for how they evaluate risk. If things are coming from other regulated exchanges, it's more likely that it's, coming from coins that have had their previous history checked and were not used for an illicit purpose. But certainly if it's coming from a darknet market, you want to know so you can ask the user a few additional questions. So we took the way that you're looking at source of funds right now, just on on-chain data, and we did our best fit to try and assign specific cryptocurrency assets, at least at their default level. Again, of course, you would have other risk controls in place, like trading limits and everything else you would typically do. But just for this one specific control, we would apply it very similarly here, where if someone is using like Bitcoin Mixer or Dash Private Send, which is a mixer, or Zcash Fully Shielded, which is not a mixer but has similar user intent and opt-in use case properties, then you can treat it like a medium risk, like you would treat like the way you would see a mixer with Bitcoin reported in the tool. However, if you receive funds from Monero, and at the moment as a loose fit grin, although that may change as technology changes over time, that's a bit more on the unknown. Like, you don't know it's associated with any specific past illicit purposes, but also you don't necessarily have the same comfort you have that is coming directly from a regulated exchange. So we would generally consider treating this as a similar risk to either unknown that you're currently doing that's reported in your tool, which we, based off our feedback, most people do not receive alerts for cases of unknown received. But you can probably treat it as somewhere between this and a mixing case too, where sure, there are intrinsic privacy preserving features, but perhaps a better way to learn more information or adjust your risk limit is just to better fit it into your risk-based approach. So to do that, one of the resources that we have on our website is an example tier-based verification to reduce risks. We're assuming that most compliant VASPs have some sort of tier-based verification. And so based off us asking around, in order for a user or for an exchange to feel comfortable handling some of these assets, we've received a lot of good feedback that perhaps you could just require the next tier for someone to transact in these assets. That way you may determine that you're adequately mitigating any additional risks that could come from these assets. So perhaps they may need to provide you with more information to trade with the same limit that they would trade with a lower tier, or you perhaps might determine that you already are collecting sufficient enough information to deal with these cases. Perhaps you already are asking for people's proof of address, profession, bank statements, these sorts of things. So we have this on our website. Of course, this is not something you can straight up drop in because everyone has different tiers and they have different sorts of business lines and different types of customers and counterparties that they engage with. However, think in your head, okay, well, we need to mitigate risks. What do we already do to mitigate risks? And it's probably likely that handling these privacy-preserving cryptocurrencies can already slot somewhere in there. And so you should have a discussion about how you should specifically do that. Next, you're going to run across users, and you probably already have, that opt in to use what we're considering a rare privacy-preserving feature. And so this obviously varies significantly on what specific types of privacy it provides, and then also, how likely it is that a user will use this feature. But if you have a user that mixes and it's suspicious activity for you for whatever reason, this is an example guide that we have, this privacy feature enhanced due diligence questionnaire, which gives you a starting point about what specific questions to ask of users who do use privacy features, and then also what additional information you may request. Remember, at the end of the day, you already will have this user's identity in most cases. So you're really concerned about, what might the user be trying to do to obfuscate the source of funds. And so you can just ask more questions from this user to learn more information about the source of funds if you are ever concerned about, not having enough information here. So again, this is where you can ask some additional basic questions. And then on our website too, we also have technical guides that show how you can specifically take some information that is provided to you by customers and to be able to put it into the wallet software and specifically do risk checks on those sorts of things too. So at ComplyFirst, we really are trying to make the guides very focused so you can take them and with very minimal effort compared to building them from scratch, adapt them into your existing compliance systems. One last note I want to make here on the funds travel rule, because everyone talks about the funds travel rule, right? When you are sending funds from one institution to the next institution, and it is covered under the funds travel rule, where you do need to share some information here, we argue at ComplyFirst that it does not matter what asset is actually being transacted in these cases. So if you are sending funds in Bitcoin, say, from institution 1 to institution 2, obviously Bitcoin itself doesn't really provide a high degree of anonymizing functions there, but let's say for some reason the funds were mixed, right? It obfuscates some information from the public, but it doesn't hide anything between the two institutions. Both institutions already know each other's identity, they know the purpose of the transfer, and they're already getting information about the intent of the transfer off-chain, out of band. So the same case happens for any privacy-preserving cryptocurrency. If I sent funds from one institution to another, in Monero, for example, sure, the public does not know anything about this transaction, but critically, the institutions both know who they are, they know the amount transacted, and they know the information about the transfer. So even though there's a privacy-preserving feature that is used in these cases, it doesn't actually obfuscate information. All the information is already shared out of band that allows you to verify the purpose of the transfer itself. So in our opinion, for the funds travel rule at ComplyFirst, we believe that there is no incremental risk in dealing in privacy-preserving cryptocurrencies because it's a transfer between two trusted institutions and you already are sharing information out of band. So for example, if your institution wanted to start slow in supporting privacy-preserving cryptocurrencies, you could perhaps require initially that users only withdraw and deposit funds, to or from other regulated institutions where the travel rule does cover these cases, or to treat it in a similar information sharing method that you would with the travel rule. Although, of course, this does have user experience drawbacks. They certainly would prefer to deposit and withdraw with their own wallets. So main takeaways here, privacy technologies exist for all cryptocurrencies. This is not something that you get to ignore just because you aren't dealing in privacy preserving cryptocurrencies. It is something you need to deal with Bitcoin, Ethereum, and really every single asset that you support right now. All exchanges, Bitcoin and Ethereum's transactions are observable by regulators and even other exchanges. So take checks against the source of funds and the use of the funds from your platform very, very seriously, because regulators already do, and they increasingly will in the future. If they have any questions about your exchange, they will come to you and say, here is a list of all of these illicit funds that you've already accepted, right? That obviously puts you at a severe disadvantage when you're trying to justify why you accepted any of those funds. So you need to be very, very cautious in how you implement any KYC procedure to really mitigate the risk and to lower the amount of illicit related funds you are receiving. So the use of privacy preserving cryptocurrencies and tools, they are increasing, so you need to be prepared for them. And they may introduce additional risks for you, but these can be mitigated by either plugging it into a tier-based verification or asking for more information, setting low trade limits, things like that. You can also always conduct enhanced due diligence. So if a bank comes to you and says, hey, we have a question about this counterparty, you absolutely are able to say, okay, sure, we'll ask for more information about this transfer. That's always something you can do. You can always get provided with some additional information if you need to. If you have any questions, you can always ask. And we believe at ComplyFirst that you can't just simply say, we're not interested in privacy. At the end of the day, nobody, including exchanges, really wants these transaction records to be completely public. So privacy is an important right that people have. And so at ComplyFirst, we really do our best to make sure that exchanges feel really comfortable supporting privacy preserving cryptocurrencies, but also know how to respond in cases of heightened risk related to privacy preserving tools. And we believe that this actually can be done at relative ease, at least compared to perception. It's often perceived that, oh no, there's a huge amount of incremental risk here, but really at the end of the day, you are already exposed to almost all of these risks with Bitcoin at the moment. And so you need to have mitigation strategies in place there today. That's the end of what I had prepared on privacy preserving cryptocurrencies and tools. We want to be a resource that is able to assist to a great extent in this area. And so, we're very, very pleased that we're able to share this information with you today.
Well, Justin, this has been a fascinating presentation. I've got one question for you: is who are the members of ComplyFirst at this point in time?
Sure. So at the moment, the founding members are DB Chain, CipherTrace, Tari, and Stoic Capital. And we also had a few other people review the resources. So for the case of our specific privacy preserving cryptocurrency briefs, for example, we had each of the teams have a chance to review and respond to the documents to make sure that they were technically correct. And then also we received insight from people like the likes of Coin Center, and we also gave chances for individuals like other groups like the Blockchain Association and other exchanges to respond. So we definitely are looking for more people who are interested in addressing these challenges to join. If you see our resources and find them useful, they're living documents. We will continue to adjust them to meet the best practices. We are very interested in supporting these assets and helping VASPs get through the existing challenges that they have with any asset where someone might use it for privacy, which of course could be anything.
Well, thank you very much for your presentation. I think this is a scary area. You've given us some scary thoughts to to take back with us, but I think you've also shown us some interesting ways forward.
For more information about this presentation and a certificate of attendance, the full 5-hour course, or other educational opportunities relating to compliance, cryptocurrencies, or other virtual assets, please contact Luminous Group today.